frequently utilize SMTs for before the lecture starts. So I'll wait for your response. Put it in the education pop-out chat. Market direction. Cool. Okay. So let's break this lecture down into the components like I usually do. So we have like a study guide. So this is going to be our SMT and MXM lecture. And I want to teach you guys a few critical things today. So the first thing, we're going to talk about generally what SMTs are and are not. Then we're going to talk about how to utilize SMTs, right? As we'll just keep it there. And then we're going to talk about highest probability SMTs in the market, right? And there's two types of SMTs, right? Can anyone put in the types of SMTs that you've heard me talk about in the chat? I am recording. Okay, so let me see. PDRA SMT, SMT for inefficiency, nice. Okay, cool. That's a good answer. I like that. That's another SMT that's not often talked about. So this is going to be our lecture contents. So let's start by having a conversation about what SMTs are and what SMTs are not. So SMTs are, as we talked about right now, right? They are a confluence. They are not, well, they're a confluence, right? For market delivery phases. Remember, the phases of market delivery are accumulation, right? Manipulation, or you can even say retracement, reversal, expansion. Now these are our market cycles. So you can think of these delivery phases or market cycles. Now, how are they a confluence for market delivery phases or market cycles? Well, generally speaking, what we will say is that an SMT is going to confirm the end and beginning, right? Because those two things are tied, the end of one phase, the beginning of another, of market cycles. So what does that more accurately mean? For example, right? Accumulation ends with an SMT. Distribution or expansion begins with an SMT. Yo, Jay, who is that? Oh, Key, what's up? How's it going? We're doing our lecture on SMTs and market maker models. I'm recording it as well. We just got into the main content of this lecture today. Okay, so SMTs are used to confirm the end and the beginning of a market cycle. For example, an accumulation will end with a smart money divergence or technique, and expansion will begin with an SMT. We will move from a retracement into an expansion with an SMT as well. A reversal in the market, which is something you guys all put in chat, right? And something that you've probably seen as a common expression that I use is that SMT signifies what? Smart money reversal, right? So this is showing your understanding that market delivery phases can be gleaned, right? We can get insight into what phase of market delivery we are in based on SMT. That's what it is. It's a confluence for market delivery phases or market cycles, okay? That's the primary tool, and that's how we're going to use it. Now let's talk about what SMTs are not, okay? SMTs are not entry techniques. They are not bias techniques. And they are not, right, accurate on both sides of the market. Now, why do I make an emphasis on that third point? How many times have you guys seen both a bearish and a bullish SMT. How frequently does that occur? Someone come off mute and say, how many times they've been confused by seeing SMTs on both sides of the market? Yeah. Almost every day. Exactly. Every single day. Now, what SMT do you think is going to be the only... yes, especially on lower time frames. Now, what do you think I'm going to say about SMTs that happen on both sides of the market? Which one should you care about? Say you see an SMT that looks like this. And one that looks like that. Yeah, which one are you going to care about? One that maps with what? You're on the right track. Institutional order flow. I like that. I like that, those words specifically. So you're going to care about the SMT, right? SMT aligned with institutional order flow. And this is going to be essentially another way of saying your bias. You're not going to care about the SMT that does not align with your bias. It's just going to be noise. And in a lot of cases, you're looking for SMTs in the wrong places, which is why some people's charts will have SMTs all over the place. When in reality, you need one or two key level SMTs to kind of signify an entire price move. So we're going to talk about how to utilize SMTs and then where the highest probability SMTs actually are. So when you start looking for them, it's no longer a pattern. Because remember, most things are taught as patterns, right? An SMT is a higher low on one index and a lower low on the other. It is that as a pattern, but without a narrative for why price is diverging, right? It doesn't mean anything. It's just a pattern. It's just a pattern in price. And as you know, those will never actually do well for you. Okay, so these are what SMTs are and what SMTs are not. I'm going to delete these as we keep moving just so I have more space. Now let's talk about, right, the types of SMTs you can look for. Also, just a general thing for SMTs. Say I'm bullish, right? We'll talk about this in all cases. So in all cases, say I am bullish on the indices market. Do I want to long, one, the pair that sweeps liquidity, two, the pair that makes the failure swing? Which one do you guys think? Put it in the chat, one or two. So for example, today we'll use this example on the NASDAQ. The NASDAQ here on Monday and Tuesday made a bullish SMT divergence at the previous day low with the ES. So that means if I was to look at the ES made a lower low here and the NASDAQ made a higher low. Which pair do you want to long and why? One failure. I'm seeing a lot of I'm seeing a couple of answers that say the one that sweeps liquidity, and then I see SM saying the one that made the higher low. First is order paired. Okay, good. I'm glad that there's both responses here. So I'm going to teach you how it's taught in the school of ICT and how I visualize this, because I don't do things directly from the book of ICT, as you guys know. I like to make my own observations and build on them. So what ICT, which one do you guys think ICT teaches? Failure swing, yeah. ICT teaches you want to long the pair, so ICT teaches you want to do number 2. And this is because the failure swing shows that institutional order flow is refusing to make a lower low and take out accumulated positions on one of the indices. That generally means, especially on the higher time frames, that if there is institutional longs below a certain low, the failure swing shows that there is reaccumulation without stopping out those previous longs, showing that the market is more bullish in this case. So the general school of thought is that you want to long the pair that is showing relative strength and diverging bullishly. You want to long the pair that puts in the failure swing or makes the higher low. Now you will notice often, right, that also doesn't work, because just as you see NASDAQ here on this 4-hour chart made a higher low than the ES, I want you to refer back to this weekly chart, and I want you to look at the NASDAQ here inside of this inefficiency. So this right here is a weekly imbalance. This is a buy-side imbalance, sell-side inefficiency on the weekly chart. Now compare this with the ES. What do you notice about the ES on the weekly chart? Did it diverge bullishly in the gap, or did it come into the gap? It diverged bullishly. So the common response here would be to long the ES. That's what ICT would teach, right? He would say that because we diverged inside of this fair value gap, the ES has relative strength in comparison to the NASDAQ. Now, as we saw in the state of delivery this whole entire week, the ES continued to show relative weakness. Now, why does that make sense, right? Why would the ES show relative weakness, making these lower lows all week, if it was the pair that diverged bullishly inside of the gap? Remember, go back to the NASDAQ chart. The NASDAQ actually traded lower, right? The NASDAQ came into this fair value gap. So technically speaking, on the weekly chart, the NASDAQ should be weaker. And yet you can see that the NASDAQ state of delivery, right, from Monday to Wednesday, this is the weekly open. Let's go to Monday. Let's go right here. This right here is the weekly open on the NASDAQ, and this right here is the weekly open on the ES. I'll mark out that same price level. Well, we can clearly see the NASDAQ was much stronger in its delivery throughout this week. Even though they both reached into external range highs, right, all-time highs, NASDAQ not only reached into its external range highs first, reaching into the previous week high and the external range highs first, but it also had bullish divergence throughout the entire week with higher lows. So the reason why, at least the reason why I've observed, why this hard and fast rule doesn't always work of longing the pair that makes the failure swing, is because what I like to do is consider both higher time frame and lower time frame divergences and use both ideas. So what I will say generally, and we talked about this in our last lesson, we talked about something called sequential SMT, is that on the higher time frame, right? So for example, weekly, monthly, even daily, the pair that is diverging bullishly is quote unquote stronger. However, right, on the lower time frame, we have to consider order pair, which is something I saw in the chat, right, from, who said order pairing? Todd. So Todd mentioned the idea of order pairing. So what I would say, and what I would argue, which is something that ICT doesn't teach, is that despite NASDAQ making the lower low on the weekly chart, I can see that it has order paired relative equal lows inside of a fair value gap here. So this is going to be our sell side liquidity, which we had relative equal lows for. We purged that. And then I'm looking to see which index has the lower resistance liquidity run to the buy side. I'm going to say that again. The lower time frame, we consider order pairing, right? So what does that mean? Order pairing means we are mapping a specific low to a specific high. That means smart money is absorbing sell stops and pairing these sell stops here with these buy stops. It's just a one-way transaction. There's no partials. There's nothing in between. It's these lows get offset, right? Distribution, offset accumulation, and then offset distribution. We've talked a lot about this concept kind of in many of our lectures. And the idea is that if you're thinking like smart money, there is only one objective target, which is going to be old highs and premium imbalances in the market. So let's consider the dynamics of that argument and show why NASDAQ was clearly the better option to long this week. So not only did NASDAQ trade in below these lows, order pairing them. I'm also going to grab my ES chart here so we can compare them, right? Yeah. Yeah, absolutely, absolutely. Okay, so order pairing as a concept refers to, let me make this my ES chart quickly, and then I can answer that question. Cool. I have to mute someone's mic. I'm going to mute Yusuf's mic just quickly. Perfect. Okay. So order pairing refers to the concept that specific lows in the market are the point at which smart money can get filled, right? I have to mute whoever else is unmuted. Okay, cool. Order pairing refers to the idea that if smart money wants to get involved in longs, and you've seen the liquidity imbalance theory lecture, right, SM? So if smart money wants to get involved in longs, they require a significant pool of liquidity to be liquidated in order to offset their long orders, right? And what do we know those liquidity pools to be if they want to get long? What are those types of stops called? Yeah, sell stops, right? So below here rests a sell to close order, which means what's the other side of a sell to close order? Yep, buy to open, exactly. Buy to open, right? So in order for this transaction to occur in the market, in order for smart money to get filled on the shares that they want to be filled on, they require, right, a level of sponsorship of sells. Now, what does that mean? Sponsorship of sells means that the market is going to actively provide them with sells. If there is no sponsorship of the market for sells, they will not be filled in their contracts before price slips away, which we talk about in that liquidity imbalance theory. So order pairing simply refers to the concept of these specific lows needing to be offset at a specific location. Now, the same argument we used for their fills, could we not use for their exits as well, SM? What happens if they try and sell all of their longs back to the market? What would price do? Yeah, price would explode higher and they wouldn't get filled, right? So now they've bought many shares and they cannot simply sell all those shares or else price would explode higher and they'd get slipped, right? Because immediately they'd flood the market with certain sells and then either they'd get slipped higher or the price would dump, right? And they still wouldn't get filled. Both ways. One of the two would happen, right? Either a lot of market shares are going to be bought by some participants at a certain price the minute they try and sell it, which is going to bid the market up very quickly, or they're going to try and sell, and that max influx of sell orders is going to make the price go lower based on, supply and demand of shares in the market, and therefore they won't get filled. Both directions. Does that make sense, from a conceptual standpoint? So they order pair those lows with a specific target. Now, what is the precedent of price delivery? What is price always doing? Where are order pairings always happening? There's 2 points that we care about. One is, buy stops and sell stops. And what's the other one? Imbalances, right? Liquidity imbalance theory, right? So let's use this argument to prove that the statement that you always want to long the pair that makes the failure swing might actually be a bit of an oversimplification of price dynamics, because I truly believe it is. In this case, what I will look for, right? I'm going to make these lines a lot less dark. Sorry, it's just really frustrating me to see that. Okay, perfect. There we go. What I'm going to look for, right, is the specific... I keep grabbing this sessions indicator. Sorry, guys. I'm not trying to grab that. Here we go. Oh, maybe it's not visible in here. That's why. There we go. Sorry about that. Okay. Sidetracked. What was I saying? So what I want to look for is I want to see specifically which one of the markets is going to offer me a better order paired target, okay? So what do we consider for order pairing? We just, Todd said one of them, which was imbalances, and SME said the other, which was what? External range liquidity, right? So remember, we're going to use everything in context of market maker models. There's nothing that exists independently of market maker models. So what's the same thing as saying imbalance? What's that type of liquidity called? There we go. And that's exactly how we understand market maker models to work, right? So what I will argue to you, and I implore you to do your own research and prove that what I'm teaching you makes sense, is that the idea that SMTs have to be certain rules about them. Like you need to long the pair that makes the lower high, right? Or the higher low. I think you should actually consider SMTs in context of market maker models, like I teach you for every concept. You want to specifically look at the SMT in relation to order pairing of that level. So in this case, I'm going to expand the chart here, okay? So you can see the ES as well. Which index has the better order paired objective? I want everyone to put it in the chat, and I'm going to go on my daily chart for you to see it. First of all, I want everyone to go in the chat, and I want you to tell me why. Why does the index that you choose have the better order paired buy side target? I'm going to mark out some levels while you guys put that in the chat. Hopefully these levels will help you. If you're confused by that, look at the levels I'm marking out on the chart. Yep. So for this low down here, for example, we're looking at last week, right? Do you see this low right here? NASDAQ makes a lower low. It comes in to this fair value gap on the weekly chart that you can see. The same one is marked out on both indices. So NASDAQ comes into this fair value gap in here, and ES makes a failure swing to that fair value gap. Which of the two indices, right, looking at last week here, which of the two indices have a better order paired objective to the buy side? Because we are assuming that price is going to be bullish from that internal range of liquidity. The question I have for you is that despite NASDAQ making a lower low and ES making a higher low, which index has a better liquidity target to pair these sell stops with? I'm going to mark out the sell stops on both. And put it in the chat and put why. Does that answer your question at least? Before you can respond? All right. And I'm giving you guys a few hints on the chart with these annotations that hopefully you guys can utilize. NQ because it has a lower time frame imbalance on the daily. I like that answer key. NQ, buy side imbalance. NQ because the FVG. NQ as the LRLR. Yes! Fantastic, guys. Absolutely. Can everyone see that very clearly from what they are observing on this chart? So I don't like patterns. You guys know that. And I especially don't like the patterned rule that the pair that makes the lower low or the pair that makes the higher low needs to be shorted or longed. I don't like rules. What I like is a reason, which is narrative. Why is NASDAQ making the lower low here? And why do I believe NASDAQ to be the pair that should be longed from that SMT divergence? Not ES made a higher low. ES is stronger. Let's long ES. As you notice, which pair ends up delivering with more strength, ES or NASDAQ? In this price leg, remember, just from this SMT divergence we're watching, so this leg. Well, you can clearly see it's the NASDAQ, right? And it's been the NASDAQ ever since we order paired this liquidity down here. The NASDAQ engineered equal highs that are low resistance and had a clear sell side imbalance, buy side inefficiency target on the daily chart with failure swings. Whereas the ES had no imbalance, and instead of creating a fair value gap, right, a displaced fair value gap, it created this high resistance liquidity wick. On the hourly time frame, you can see that dynamic in the chart, right? But just using the rule that ES made the higher low means that if we actually look at this high, this specific high, it's actually the NASDAQ that on this day, Tuesday, has the price run into that high. And it trades into that high and into its liquidity target much before the ES does. As you can see, the ES, when the NASDAQ eventually sweeps out the LRLR that it created, at this point, the ES is still trading below that high resistance liquidity run that was formed with this breaker. Now, NASDAQ did not form a breaker. ES formed a low, a high, a lower low. So that means that it has to trade through this high resistance area of price, this order block, and then this breaker to the left of it. Look at how ES struggles repeatedly to come into this high resistance liquidity. Because despite it diverging and order pairing these lows, in doing so, in the formation of that SMT, what it does is it creates a higher resistance liquidity run, which is why we want to always be considering the lower time frame order pairing dynamics, external and internal range liquidity targets. I want you to get rid of this idea that you need to follow a rule for SMT divergences. You can use either one of them, the pair that sweeps liquidity or the pair that makes the failure swing. How I want you to differentiate, so the Fees method, right? Considers lower time frame order pairing dynamics. That's it. That's not as pretty, right? That's not as easy as saying, oh, you're always going to long the pair that makes the lower low or the higher low. Lots of traders and lots of educators will tell you that. That's just simply not what I do. And you'll see most times I will always consider what has, the better liquidity target. What can I actually say this low is going to be order paired with? And for me, there's a clear bias, right, that supports NASDAQ being more bullish into that high despite making the lower low. Likewise, when we consider this week's dynamics, okay? This was last week. And it was a very interesting case study where NASDAQ, the pair that was more bearish, actually provided the much nicer move. Like ES really struggled. And you can even look at the depth of these hourly retracements if you want more arguments. Look at this. So while NASDAQ does not come back in to this area of price once it leaves it, right? That same area of price on the ES is revisited not once, not twice, but 3 times, forming deep retracements of institutional order flow. I mean, all you gotta do is ask yourself, what do I define institutional order flow as? What candles are we respecting? What are we disrespecting? Notice how once we start to displace on the NASDAQ, every single down close candle is being respected. Every single down close candle is being respected in this price leg. Here we have a deeper retracement, which is time distortion because we don't have news on Wednesday. Look at the mean threshold of this candle. Right? Every single down close candle respected. Whereas the ES, you can't say that to be true. We're getting deep retracements into past the mean threshold of these down close candles, like this one, for example, once we close through it, the order flow from an institutional standpoint is heavier in this price leg and more expansive in this price leg, despite ES making the higher low. And that's because it has a higher resistance order paired target. There is no pending buy stops above these relative equal highs anymore. They have been purged. Whereas NASDAQ failed to do that. It created a series of failure swings. All of this is defined as a low resistance liquidity run condition, with a magnet of price being the sell side imbalance, buy side inefficiency. Two targets. What's one of the targets? One of the targets is IRL, the imbalance. The other target, ERL, the failure swings. For me, that takes precedent over any rule of how an SMT should be used. Let's look at this week and use a very similar analysis. So, this week, zooming out, right? What can we say about the delivery between the NASDAQ and the ES? Well, as you can see, both the ES and the NASDAQ come in and create a swing failure at these all-time highs, both of them. In this case, it's going to be a higher resistance run into this high, right, and this high, both of them. So what am I going to use to qualify which pair to long based on divergences? Well, for me, I can already use the idea that we've order paired the weekly inefficiency, and now I can start to view this as relative strength on the NASDAQ, creating higher lows while the ES continues to trade lower and lower and lower and create lower lows. They both have the same institutional objective. This is the previous week high, or external range liquidity on the weekly, and this is all-time highs. So the target is the same. Neither pair has created a jagged edge up there. So now we use the traditional concept of relative strength and weakness to say, well, obviously in this case, I'm going to be wanting to long the NASDAQ. Because look what happens on Monday. On Monday, the NASDAQ comes in, forms an SMT, right? Let's zoom out. Right here. I don't know why all of these lowered. I don't like the fact that we're showing all of these lower time frame SMTs. The NASDAQ forms this very large divergence, which is nice because it's in context of the previous weekly wick. Remember, we already came in to that weekly imbalance. ES has not come into that weekly imbalance, which is why it is heavier to the sell side in the early portion of the week. It still has pending liquidity that rests in here in the form of sell stops and IRL. NASDAQ has already paired this level. So now we wouldn't expect this low to be traded into. So now you're seeing a traditional form of classic strength or classic support and resistance in this case, and relative strength. So we should find that this area will support price, right? Because it's already come into the imbalance. Now we're using a logic again, not a pattern, but logic for why we think NASDAQ should be stronger this week. So now when we see this SMT form, it makes sense. Yeah, we don't want to see NASDAQ trade back below this low. That would be much more bearish on NASDAQ. NASDAQ shouldn't come into here. In fact, the lowest NASDAQ should want to come into is the halfway point or a discount of this wick. As you can see, once we start to flip up a time frame, you'll see it's exactly where NASDAQ comes into, right? Comes in, engages that discount wick level. Same thing on the daily chart, right? Right here, if we look at this down close candle, what does this become, everyone? Everyone tell me in the chat, what is this down close candle on the daily once we trade through it? Someone say it out loud. Order block, right? Yeah? Makes sense for it to be an order block? Yeah. Yeah, and also I like what Todd said, BPR. Yes, that's the right answer as well. What do you notice about the price delivery here? Sell side, then buy side. So this down close candle, right, with the engulfing up close candle, once we close through it, is a balanced price range. Price shouldn't come back below here. Again, no pattern here, just logic for why price shouldn't return to that area. Now compare that with the ES. What do you notice about the strength of delivery of these candles in here? Again, there's no target, remember, there's no imbalance. So once we close through this candle, you see price is holding this order block. But because it hasn't paired these stop losses, you'll notice it's continuing to seek sell side in the form, right, of these manipulation wicks. Whereas NASDAQ is clearly showing that this move here, this balanced price range, the reason why this one holds and this one doesn't hold is because this down close candle here does not engage the liquidity. Remember, this is the basis for the narrative, is that this SMT formed for a reason to run out these stop losses. So now there's no more liquidity. Where does price chase in the market? Imbalance and liquidity. So because we've already order paired the lows, it's expectationally valid to say I want NASDAQ to be stronger for the rest of the week. It makes sense. Then you see the first way ICT teaches SMT, which is to focus on the pair that makes the higher low, but only because of the context, not because it's a higher low. And then, of course, you can see all week we get that stronger delivery into our only objective order paired target, right? Previous week high, all-time high. Okay, so that was a lot. And watch the recording several times and then go in your charts and back test it. Prove to yourself that the Afiz method here, right, of looking at lower time frame order pairing and these dynamics, market maker models, right? What does this right here really mean? This is a fancy way of saying which market has the cleaner LR, MMXM, right? That's the only other way I'm saying it. Sure, we can talk about liquidity targets, but liquidity targets are always in context of market maker models, right? So which market has the cleaner low resistance market maker model? That's the pair you long, that's the pair you short, okay? So again, we can expand this argument to the sell side of the curve, which I will quickly do, and then we will move on to the rest of the lecture topics. And the rest of the lecture topics I want to talk about are how to look for a high probability SMTs, where to look for them, and then kind of how we integrate them into a trading model. Okay, so let's use the same example on the sell side of the curve. Okay, I'm gonna take a picture of this so I can delete this. Again, it's all recorded, so you guys will have access to all this, but this is the Afiz method. I'll just put it in the chat for now. Cool. Okay. I want you to see how this argument also remains true on the sell side of the curve. I want you to see the internal consistency of what I'm teaching you right here. What do you notice about the sell side of the curve? Why do you think NASDAQ reached into these daily lows and the ES didn't? Someone tell me. What are they noticing? Someone come off mute and say it, because it should be very, very obvious. Yes, and what about the type of liquidity? Is it higher or lower resistance on the NASDAQ? So in this case, on the sell side of the curve, which index do you want to short? And why is that reason? Say it in one complete sentence from the Afiz method. Perfect. That was a little bit scuffed, but the NASDAQ has the cleaner, lower time frame market maker model. Clearly, you can see that. Now, what is this type of liquidity run in here? Why is it higher resistance? Again, remove the idea of a pattern in your head. Why is this higher resistance? Not because it makes a lower low, but what specifically about this makes this higher resistance? Yes, nice. Order pairing of what? The sell side. What else? What else are we engaging here that we're not engaging in the NASDAQ? You can see it as a yes. So what is the market always seeking? Remember, two things. Has internal or FV, fair value, been offered from this range before price moved higher? Has external been offered in this range? Yeah, it has. right, in ES? Has internal been offered in this range? Have we had a deep retracement of this fair value gap? Remember, when we consider fair value gaps, we use quartiles to look at the range of delivery. Have we delivered fair value of this gap? Yes or no? No, right? Yeah, this is a measure. This is a measuring gap. You want to see something cool? Where is the origin of this price leg? Well, we can say the origin of this price leg is this swing low. Well, that's pretty random, isn't it? That must be random. I surely cherry picked this, right? I went in before the lesson. I knew this would exactly be that, right? No, of course not. There's an internal logic to what I'm teaching you, right? What do we know about measuring gaps? They're high probability projection tools, right? So this right here is 2372.25. And this right here is 2371, right? It's 1 point difference between this measuring gap, which was 2 weeks from this event, 3 weeks from this event, or 2 weeks from this event. And we have a beautiful reaccumulation, redistribution, right, into the level of interest. Now, is this a measuring gap in here, or is this just a regular fair value gap? You tell me. Which one is this? SM? Regular fair value gap, right? So I wouldn't be using a projection like that. Instead, I might be using a projection that was based on this SMT. Maybe something like this. Right, that. Anyways, that was just a cool projection thing. I noticed this the other day, and I didn't have this on my chart from a couple weeks ago. It would have been really nice if I had seen this. I just didn't see it at the time. But this is a prime example of a very high confluence measuring gap. Origin of the price leg, which starts again with, right, this swing low, intermediate term low comes into this gap, and then we start this displacement, forms a beautiful measuring gap, and then delivers almost perfectly into that high. Anyways, regardless of that confluence, what we notice is that this in here is already offering fair value, correct? In both ways. It's offering external range liquidity and it's offering internal range liquidity. Has NASDAQ done either of those things? No, right? NASDAQ hasn't done either of those things. It did not offer fair value, and it did not offer sell side. So this is why we're going to use the pair in this case that formed the higher low on the buy side of the curve, right? And has the cleaner lower time frame MMXM. Which is contrary, right, to this sweep right here. Some people might say, look at this sweep right here, right? Make a higher low on the NASDAQ. There's the SMT divergence. See? Notice how in this case, which index is heavier into the low, SM? Which one? Yeah, into sell side. Yeah. And that's why NASDAQ fails to reach up as high. Do you see how ES reaches up higher into this liquidity? What's NASDAQ saving that for? What is this liquidity being reserved for when we think about that term order pairing? Why is NASDAQ not taking out that high? Because that high is going to be order paired with this low. They're leaving that for the buy side of the curve. Does that make sense? So we have internal range liquidity here in the weekly fair value gap. We have a daily double bottom. We are not going to pair this high until we sweep that low. The ES is not going to reach into this low, is it? So this move higher, do you see how the delivery state to the sell side is so much choppier on the ES? This is time distortion in here. Well, it's waiting for NASDAQ to do what? Exactly. And then you get the reversal in the market. So ES doesn't want to reach down into here. In fact, it may only reach down as low as what on... Now we're blending lectures. Remember the PD array matrix? Gabriel, what is the unmitigated PD array in this price leg? There's one that my eye goes to. Gabriel? Nice. This one, right? You can clearly see that we were trading into this fair value gap. So this becomes mitigated, right? But the only thing we have not retested is this down close candle in here. The one that forms what? What forms right here? Remember, this is an SMT lecture. So what forms right here? SMT, right? Okay, so this is an unmitigated breaker. Look where price will reach into. At the lowest, we'll reach in. So let's go to the bodies, not the wick. That must be random, right? That is the unmitigated portion of this price leg. So what is the market doing? Remember we talked about this in the market cycles or in the PD array matrix lecture. What is the market always doing? It's either running out highs or offering what? As price, the opening, as ICT directly quotes, remember, the opening price of an order block is defined as fair value. That's what ICT says in 2021 or 2022 mentorship. I think Interdiscipline made a post about this the other day. The opening price of an order block is fair value. So where has price failed to offer? Fair value. Where do we form the weekly SMT this weekend? Fair value. Of what? This dealing range. I'm not talking about premium discount fair value. I'm not talking about this type of fair value, which is a dealing range. What I'm talking about is of the displacement leg, the dealing range, right? We already know that, does the ES want to come below sell side here? Yes or no? Based on what we've seen in this price leg here. Is it high or low resistance? High. Low resistance here. So we want SMT to form here. And where do we want SMT to form? At fair value. Has this order block been offered by the market? No. Where does it get offered? And what does it get offered with? What is the marketing offering fair value with? Someone tell me. With SMT. So that leads me beautifully into the next lecture topic, which is going to be how we utilize high probability SMTs. Now, based on that conversation, what do you think I'm going to say about where to look for SMTs? Ah, nice. So again, you'll be taught SMTs in a pattern way, but the proper way to use it is defined, right? Is defined within the scope of fair value and PD arrays. PD arrays, by definition, are the market offering fair value. We talked about this in that equilibrium, or in that previous lecture on PD array hierarchy. When the market is not seeking out old liquidity in the form of buy stops and sell stops, it is offering fair value in PD arrays, right? In premium and discount of dealing ranges. So SMTs, the correct way is to define their validity within the context of fair value and PD arrays. We don't look for SMTs unless there's a reason for price to form an SMT at the level. I'm going to say it again. We do not care about an SMT. We do not look at it unless there is a reason in the narrative of a price run for that SMT to occur in the context of fair value and PD arrays. Remember, PD arrays can be ERL or IRL, right? Because what's at the bottom and top of the PD array matrix, Gabriel? Liquidity. So people forget that external range liquidity is a PD array. So external range liquidity is fair value as well. Offering stop losses is the ultimate form of a PD array. In fact, it's the most prominent and the end point of every single price leg. So if we're offering multiple forms of fair value in this price leg, eventually we'll offer this swing high, which is liquidity that we're running out. Okay, so that's how we're gonna use SMTs the right way or the proper way. I hope. Now this lecture is it's a lot of content, so you'll have to go back in and you'll have to go through the components. But this is the last thing I want to touch on today, which is how to actually use them and how to actually find the right ones, because you've most certainly been looking at SMTs incorrectly, because I looked at SMTs incorrectly for the longest time and I used it in all the wrong ways. I used it for an entry technique. I used it for a bias tool. I used it to say, I want to long the index that makes the higher low when I started, because that's what ICT said. And I genuinely don't believe that's the complexity that you need, or that's the understanding you need to have of SMTs. I think there's so much more complexity to SMTs that is completely overlooked. And I know a lot of other influencers and traders use SMTs in different ways. So guys like Day talk about sequential SMT, and they look at precision swing points and things that form around SMT. I'm not going to teach you any of that. You don't need to. I just think it's noise. But what I do want you to understand is that if you look at SMTs in context of what you've learned in this lecture, meaning why you want to long one versus the other, why you want to look at the order pairing dynamics or the market maker model dynamics, and why you want to look at them in context of PD arrays, I believe you're going to have an edge over 90% of ICT traders who just say, oh, SMT here, we must be reversing. Yeah, of course, right? We've talked about that. It signifies one change of delivery state to another. And I'm not even going to go into that much detail in this lecture on that, because I talk about that in the market cycles lecture. If you guys have seen that, I talk about how there is no SMR without an SMT. That's not the focus of this lecture. I want to really focus on when we see that SMT, how to be using it properly and understanding it properly. So now let's talk about how we're going to use them in context of PD arrays. So generally speaking, right? To confirm, I'm going to put this in quotes, inside of a PD array or context area, we are expecting a short-term market maker model to form around. Say that again. We want to utilize SMT to confirm the smart money reversal inside of a PD array or context area, same thing as saying PD array, that we are already expecting a market maker model to form around. Which is why you'll notice in Hafiz's trading plan, one of his conditions for a trade is, right, H1 PD array plus SMT. Now that's combining the idea that we talked about in the market cycles lecture, that I will be able to confirm that I am trading alongside the distribution of my market maker model when I see my context area and my SMT. So no SMT, no trade. No hourly context area, no trade. If I have an hourly context area and an SMT, well, now I'm confirming the classic, right? Internal to external MMXM, right? This is the MMXM, targeting just that high from this internal range. Remember, internal range of liquidity to external range of liquidity. That's the market maker model. And unless I see the SMT, I cannot confirm that this hourly context area is offering the short-term smart money reversal. If there is no SMT inside of my context area, I do not know that the phase of manipulation, or in this case, short-term reversal, has ended. The SMT will signify the SMR with the right structure around it in terms of, internal ranges, SysD, all the good stuff that we trade. So we're not using it as a pattern. We're not using it for our bias. We are already long biased in this case. Why? Based on everything we just talked about. Weekly divergence inside of the context area, break a structure, balance price range, and returning back in to this discounted area of this balanced price range. That's why we're bullish. Now the SMT is going to confirm that in this trade thesis, I have a setup. So let's look at that. Here is my hourly internal level, okay? Or 4-hour internal level, rather. You can see, once I'm in my 4-hour internal level, let's use the 50-minute market maker model in this case. And I will pull up that same 4-hour internal level on the ES as well. I'm going to sync the time zones 1 second. Time and the interval, there we go. Okay, let's look at a trade idea and exactly how I use it, and then I'm going to give you guys some homework to go in and essentially backtest everything you learned today so that you can prove it to yourself. So as you can see, we don't have displacement in that same area. So we only have this 4-hour context area, and we have these swing lows. So I'll go down to my 15-minute chart, and again, right inside of my 4-hour context area, I am now looking for my 15-minute at least SMT to signify that this is going to be the low of this short-term reversal. Okay, so in here, you can clearly see we form a beautiful SMT inside of my 4-hour context area. And again, which pair am I longing? The pair that I utilize order pairing on the lower time frame for, and see which one has a smoother target, essentially a smoother edge for me to target. So what do I see here? Once I see this SMT form, I'm more bullish on the NASDAQ based on everything we just talked about, right, over the past like 20 minutes, our entire weekly analysis. Then what do I see in terms of the lower time frame dynamics? Well, what I see is that in here, right, in this range, we actually form, what do you guys notice about the lower time frame market maker model? Actually, let's say if we're going to target this high. So this is our buy stops. I'm going to go down one more time frame as well, but I'm just going to mark out the buy stops in both cases. So we're more bullish on the NASDAQ, so we already want to be longing the NASDAQ. Now, I also want to go down one more time frame to a 5-minute chart so we can actually see the full market maker model here. Perfect. We have our SMT marked out. Which index do you think has the cleaner market maker buy model based on this? Why? We're using that same concept, right? So, well, first of all, higher time frame. Which one are you more bullish on? Let's use the again narrative approach to SMT. Higher time frame. Which one's more bullish? NASDAQ or NQ? Nice. Lower time frame, order pairing dynamics, which is essentially the same thing as saying MMXM clean. How clean is it? Or could we just say smooth edges? Yeah, smooth edges / MMXM. This is all the same thing. Again, all these terms mean the same thing. Which one's favorite, NQ or ES? Which one has smoother edges? Do you guys actively see how this sweep right here, very shallow, whereas this sweep here has aggressive accumulation, not aggressive, you can say it has active accumulation inside of this high, right? Above that high, below it, above that high, below it. Where is going to be a lower resistance draw on liquidity? NASDAQ or NQ? Or a NASDAQ or ES? Yeah, clearly, right? These have already been absorbed. We've had absorption of this liquidity. Can you see that? Absorption, retracement, and then another stop hunt. So how many stop hunts do we have above? How many drives do we take above this liquidity, first of all? 1, 2, 3, even 4, right? NASDAQ has 1, 2, and they're just ticks, like 1 tick over that high, right? So you can clearly see that ES is order paired that high more effectively. And then it comes in and makes the lower low. Again, remember the argument we were using. Why does it make sense for ES to order pair that high? Where is it eventually going to go? Lower or higher than NASDAQ? Let's zoom out again. Where is that high being order paired with? The low, right? These lows, right? All this low resistance liquidity that exists in the market. So it's already utilized that liquidity as what? An order paired target, right? So these buy stops are mapped with these sell stops. Does that make sense or is that confusing? Be honest, was that a confusing statement? Or does that make sense how this order pairing gives us a stronger and more energetic delivery into the sell side liquidity? You can see it. We trade much lower. Yeah, we trade lower and with more displacement on the ES all the way into the liquidity, whereas NASDAQ doesn't come even close to it. NASDAQ forms a huge divergence at that same liquidity pool. So we've already order paired and placed an institutional sell with an institutional buy. Now, the institutional buy has higher resistance to come back up to this high. So we want to long NASDAQ because we have the higher time frame and lower time frame dynamics aligning with NASDAQ. So that's where we use SMT on this higher time frame to qualify our trade. Now, from the 4 hour, let's use a 50-minute market maker model. Even though in this case, I'd probably use a 5-minute because it looks a bit cleaner. You can notice that we have, it's fine on the 50-minute, but all of these down close candles are a lot for me to wait for price to close through. So for example, my trade idea on the 50-minute chart would only look like this. Oops. All right, that's our SIST. Where is it? And then I'd go long from there to there, right? Risking probably this low, which is only a 1 hour trade, right? Now for me, I know I want to get involved in this move because I see this as a Judas swing. Look, 930 London lows, manipulate them, reverse against them. This is the Judas protraction profile. So I know I want to look for a lower time frame model in here. I don't want to wait for that 15-minute. But really importantly, what can you say about, I mean, we had an argument in our heads that NASDAQ was stronger. Did we confirm, what is the 50-minute chart showing you in terms of the change in state of delivery on the NASDAQ? Did the ES shift delivery state at all in this entire day? No. So the ES not only didn't come into buy side liquidity, what did it fail to do? Look, and it makes another lower low. See that? You see how, okay, here's the really cool thing. Once we form this SMT, right? And once we have this 4 hour into 15-minute market maker buy model, again, this is just the short-term target. Where's the ultimate target for the 50-minute model? You guys can see it up here, right? That's the ultimate target, the higher time frame target. We all agree with that? Okay, here's the really cool thing. Let's mark out that higher time frame target and still use the concept of SMT and relative strength. ES never shifts delivery state above that high, does it? Above this down close candle. So this day you would have chosen to long NASDAQ. What do you notice about what happens the next day? Someone tell me. While I annotate my chart. Someone tell me what happens the next day. Forming what? So when this SMT forms, is it a pattern or is there a lot of narrative associated with this specific SMT? Now, why did I say, right, on Tuesday, we're likely to have the low of the weekend? What do you think I'm seeing here when I see this specific dynamic? NASDAQ has traded above its liquidity, shifted delivery state, order paired the lows. Does it have any reason to come back into that low? No. But look at the ES. Has it ever shifted delivery state? No. So it forms another divergence. That's when I said on Tuesday the low of the week is in. When people were bearish, I said the low of the week was in using just this idea of SMT. That's when it wasn't used for my bias, but the narrative associated with it confirmed weekly internal to external. For me, once I saw this, weekly internal to external was exceptionally more likely than us trading lower on the ES into here. Because once the ES swept that low on Tuesday, the first day we traded long this week, right? That when we saw these, we saw the fact that we still had sell side delivery targets lower. We said now we're getting all the internal dynamics with the SMTs to support higher prices, and then we use our regular confluence tool in addition to SMTs, such as where do you think this comes into in relation to this series of down close candles? Someone tell me. All right, what about if we use the entire, let's go to the hourly chart and use the entire order block on Monday. That's pretty nice. Look at the bodies, right? Do you see the bodies holding on that hourly chart? Because this specific down close candle we just saw, the specific candle that changes delivery state, this now becomes our high probability order block. Because it's an SMT that forms at a specific time of the day and of the week. Tuesday morning, SMT, inside of the PD array. Remember, we care about with context. What does context mean? PD arrays. You can't have SMT at random places. I do not care about an SMT here. If price did this randomly here and formed an SMT, it doesn't make sense to me to have any context around it. It makes sense once we trade into this previous day low, which is a PD array, and we respect this mean threshold, another PD array. Then I have the context to go long. So this is how we're going to start using SMTs. We're going to start looking for SMTs inside of our PD arrays to frame trades. So this was Tuesday. On Wednesday, we do the exact same thing. So look at our chart. We have our 1 hour key level. I mean, we traded this today, right? So for me, once I saw, this wasn't today, this was Wednesday, this was on Tuesday. We traded this yesterday. Once we came into this hourly key level with this SMT, I believe we did it on stream together, we went down to our 5 minute, and again, we looked for our SMT concept once again. So let's go back there. Okay, form the SMT. We're not trading ES because ES is obviously weaker. We already know we want to trade NASDAQ for the rest of the week. Cool. Zoom into the area of interest. Now again, what are we waiting for? What we're waiting for, what's my entry? Someone tell me, what would I wait for out of this hourly order block? What am I waiting for in terms of an entry pattern to see? Yep, right here, right? Change in state of delivery, right? ES gets that change in state of delivery as well. Cool, the indices are mapping up, everything's syncing up. We have bullish order flow. Okay, cool. Once I get that change in state of delivery, you take an entry. What do you target? These highs. Now, I said, and if you remember yesterday, I said I wanted to wait for a little bit more confirmation. I waited, right, for that next folder of news, which was at 10, and I said I want to see if we get a reaccumulation in here. So I didn't enter on the 9:30 Powell speaking. I waited for 10. So I didn't use that 1 hour market maker model. I instead looked for the next phase of distribution. Right? Again, you're probably going to understand what I'm going to get to here. What do you think I'm looking for inside of my PD array, guys? Remember the rules. This is a breaker, right? What do you think I waited for to see in this breaker to confirm the order flow? Now, you don't have to do this. Remember yesterday I didn't do this, but once I saw this thing that we've been talking about for the past hour form, I trailed my stop loss, right? So in here, we have an hourly breaker. I'm going down, and I'm looking for what? To confirm the state of delivery changing. What do you guys see here? So I'm going to mark it out. What's my entry pattern again, SM? What am I waiting for? I get that right in here, correct? Cool. Mark out that same candle on the ES. Nice. All right, so we don't retest it on this candle. So the first time we retest it, what forms? I mean, it's on my chart. You can clearly see it. So I entered on this SISD here because I didn't need to see the SMT to understand the bullish order flow. However, I was okay, and you guys were with me, and I said, I'm okay with sitting through an accumulation of the market if market doesn't expand. There was an SMT at these lows with the YM. If I can pull that up, you'll see. The reason why I entered early is because there was an SMT with the YM in that same area. Let me find it. When do we get our SISD? Oh yeah, do you see the SMT right here with YM? So I entered because I saw that, right, when we traded into my SISD. Now the reality is that has the correlation with YM really been there the past couple of weeks? No, right? So we were in an accumulation. So I entered during the accumulation, and I want you to notice what signified the accumulation actually ending. What do we get inside of the sysd? So this is our sysd. When we retest that change in state of delivery, what forms? Do we even have an SMT? Maybe I'm lying. I don't think we have an SMT of these lows. I thought we did. This would have been nice to see. That would have been nice to see. So we didn't actually have an SMT. I was more so looking for an inside this PD array. I thought I formed, but regardless, it might have been with the YM, but the crack in the correlation hasn't been there. What I would say is that the best entry technique inside of this area of price is going to be when a meaningful SMT forms. So let me see where you get the meaningful SMT. There will be one somewhere. Ah, it's right here. It's the PD array divergence right in here. There we go. Ah. Oh, we're at the order block here. Okay. Okay, I believe you. But here is the other form of SMTs. We're gonna talk about this a bit. What type of SMT is this? Is this a what did I teach you guys this is called? It's a PD array divergence. So do you notice how if you miss the entry, say you can feel a lot of FOMO and not get involved in this sysd, right? But maybe a part of your entry model is you need to see an SMT with the ES and the NASDAQ. Fair enough. So what do you wait for? That PD array divergence to form, right? You can notice it. Here we put an equal low. So you might have had a chance in here, right? If we got a sweep, but we didn't. You notice we put an equal lows. Blend in here, get a beautiful PD array divergence. And this is where the last concept I want to teach you about, which is, again, in the market cycles video, SMT signifies a state of shift in the market phases. So we're shifting market phases. So here, you can see, we have an accumulation of the market in here. This ends with an SMT with the YM right here. So that SMT ends this accumulation. Then we have an expansion phase of the market. This expansion phase in here is going to end somewhere up here with an SMT. It might be with the YM, it might be looking to the left, I don't know. This retracement is going to end with an SMT. So if we look at the YM, same area. Todd, is this where the SMT formed with the YM? Was there? I'm very curious to see if there's. Okay, I'm very curious to see if there was an SMT that formed there. Oops, I should have pulled it up on the other chart. I really do expect SMT to form here between the indices, because that would be surprising if it didn't, based on my understanding of SMTs, right? That it signifies a change in the market cycle. Oh yeah, it did form. There we go. Do you guys see that? Okay, so the accumulation phase, right in here, down at these lows, right at these diverged lows, we had the SMT that ended. This SMT between the YM and the ES, right in these candles, that ended the accumulation phase. We had an expansion phase. What ended the expansion phase? Can you see it on the YM right here? What do you guys see? Do you guys see this SMT right here? Yes, everyone see that? Yes, I need someone to speak out loud. Sometimes I feel like my mic goes mute because it does sometimes. Okay, then that expansion phase ends with SMT. Starting what phase? Someone tell me, what's the next phase? What is this obviously? Retracement? Yeah, retracement, reversal, or expansion. Or it actually is an expansion, but is it a retracement or a reversal? I would say it's a retracement, right? Higher time frame, what's the order flow, Todd? Bullish or bearish? Yeah, exactly. And the retracement phase ends with what? Fantastic. Now we have another expansion phase. I'm going to go back to the ES because I prefer using the ES. The expansion phase here, it's all fractal. This will happen on the 5-second chart. So that's how we know we can keep looking for it on all time frames. The expansion phase here eventually starts to accumulate, right? So what usually happens out of an accumulation? How do we move higher if we have an accumulation? We have an AMD usually, right? Yeah, so prove to yourself on a 5-second chart, maybe as homework, that this is a 5-second market maker buy model, right? Or a 15-second market maker buy model, coming off of what kind of divergence is this? A PD array divergence, also known as SMT, right? AMD. Then we expand, and this expansion is eventually going to start accumulating once again. Expand, and then we start to accumulate. How do we know we're accumulating? What technique did I teach you for accumulations? What do we look for? The bodies, right? We're failing to displace the body high and the body low, right? Makes sense? We're in a box. So how is this accumulation phase going to end? Inevitably, once we know we're going to move higher, how will we know? What will we see? Every time. How about an SMT? How about an SMT? Right? There will be an SMT. That's the phase of the delivery shifting from what to what, Todd? Or from, in this case, from accumulation to distribution, right? Accumulation, manipulation, expansion. So this one tick of manipulation here is going to end with what? SMT. It has to. Or else this might trade lower until it forms the low with an SMT, and then it'll trade higher. Then we'll trade higher, and we'll look for what to form at the highs? SMT. So when price eventually stops trading higher, it will be because something at this high has formed SMT. And we'll get the same cycles. So in the morning, today, how am I on a Bitcoin chart? Do it. I'm long in Bitcoin, that's why. Oh, the futures market is open. That's gonna look like such shit because it's a holiday tomorrow. Okay, so the morning, right? Same. So we're gonna zoom out, right? We're going to look for that SMT because here we have a reversal. A short-term reversal is a higher time frame what? Starts with R. A short-term reversal is a higher time frame what? If I have a chart that looks like this. This leg in here is a short-term reversal. What's that a higher time frame? What's happening in the higher time frame? Nope. So this is what the higher time frame looks like, okay? And in here, yeah, thank you. It's a retracement, right? A higher time frame retracement is always a lower time frame what? MMSM, right? If you have a bullish retracement, that's a lower time frame sell model, correct? Yes, Hafiz. Of course, we all know that. Everyone just said that with me. It wasn't just Talon. Right, you guys can see the market maker sell model in here, right? Pretty choppy, but you can see it, right? Where does the reversal high happen on the lower time frame, guys? What's forming at this yellow line? Someone tell me. What's happening at this yellow line? I'll wait. Someone's got to say it out loud. Boss said it in the chat. What's happening in the yellow line? Yes, SMT, which is why the market trades lower here. This short-term retracement is a lower time for higher time frame retracement, hourly 4-hour chart like we saw today, is the lower time frame sell model. I anticipated price to potentially trade back into here. But once I was invalidated, I looked for this SMT today to set the stage for the low of the day, which is why even if you don't see it in real time, you don't need to. You can just see it after the fact and you get structure. So look, here is the SMT. Now in the morning, you guys were there when I said I still wanted to see another price leg lower. I wanted to see this SMT form. Right? I want to see NASDAQ trade potentially below these lows because again, we have these consolidated lows and I would have wanted to see one of the indices take out them first. We didn't get that today. And I didn't think this would be the low. But once we had the structure, then I'm confident in saying low of the day is put in because of the SMT. And then what's the thing we look for every time, right? SysD I mean, we traded this all together in the morning, right? This was the trade we all took together, right? We got the SSD. And then we're like, okay, this is very likely to be the low of the day. SMT confirmed the what? The SMR. Then we go long at the SSD and we target, you know, higher time frame draws and liquidity. For us, it was going to be, where's the other failure swing? Should be up here somewhere. All-time highs, right? Then we're like, okay, we're going all-time highs, and this SMT is the low of the day. And then, of course, in hindsight, we can see very clearly that SMT did form the low of the day right in here. And it was only once we got structure that we utilized that concept. That's why I say SMT is not a bias tool. SMT is a confirmation to your known bias. I was trading against the institutional order flow, and I said that. I want to see price reverse into maybe this area right here, which would be this change in state of delivery. The reality is I completely ignored how fat this wick was. And in hindsight, price trades in to this massive order block. And where of this order block does it trade into? Right? If I actually just use the last up close candle. Well, that's almost too precise, right? Do you see that? And then Claire, or Christina, sorry, does a fantastic job of noting what did it actually trade back to on the daily. What is this called? SSD. So I didn't see that. I missed it. That's okay. I miss shit all the time, guys. I'm not perfect. But we see how SMT here gives us a more accurate narrative once we get structure. And that's why I had no problem with saying, yeah, we're going to long this, and target all-time highs, and we just hold. Risk the lows, right? These lows are protected, which is the idea someone mentioned at the very beginning of the lecture, which is SMTs confirm protected lows. Yes, of course, because SMTs are the origin of a what? SMR. And SMR is always a protected low. So now you're seeing how these concepts blend together. I'm going to end the recording. We